Okay, tax season rolls around and you're looking at the forms, right?
Yeah.
That moment where you think, should I just take the standard deduction, keep it simple?
Or do you gear up for the deep dive into receipts, the itemized route?
Exactly. It
Yeah.
feels like this huge choice. So
hmm
today, we're going to, really break down that decision. Standard versus itemized
Yeah,
deductions.
let's clear it up.
Our mission here is to make this super clear. We want you to understand when to choose one, why, and maybe uncover some little details you didn't know about. Things that could actually, save you some money.
Definitely. Those nuances matter.
Now, before we get into the thick of it, just a quick heads up. This deep dive uses material from Farhat lectures.
That's right.
All the content, the examples, everything we talk about today comes from the accounting resources over at farhatlectures.com.
It's a great resource.
Absolutely.
Sure.
So whether you're studying accounting, prepping for the CPA exam, or you're already a professional, check out the site. They've got more practice questions, video lectures, tons of support to really cement what we discuss.
Yeah, Professor Farhat's material is top-notch. Big thanks for letting us use it.
Okay, so let's dive in. Deductions. We're talking about ways to lower your taxable income after you've figured out your adjusted gross income, your AGI.
Right, that key starting point for figuring out tax liability.
And there are basically two main roads you can take from there, standard or itemized. The big question is, which road is your best bet?
Well, let's start with the standard deduction. Think of it as the government saying, here's a set amount you can deduct, no questions asked, almost like a flat discount.
Oh.
It's a fixed dollar amount set by Congress, and it mostly depends on how you file, single, married, etc.
Right.
So for instance, back in 2022, and these numbers do change, keep that in mind. If you were single or married filing separately, that standard deduction was $12,950.
$12,950. Got it.
But if you were married filing jointly, it jumped way up to $25,900.
Big difference.
Huge. And for a head of household, it was $19,400 in 2022. The key thing isn't memorizing these specific numbers because they change yearly, but understanding the concept. It's a fixed, predetermined amount based on your filing status.
Okay, so that's the straightforward path. Easy enough.
Uh,
But then there's the other option, the one that sounds like more work.
uh.
Itemizing. How does that stack up? What falls under itemized?
Right. Itemizing is definitely more hands-on. You're basically listing out specific expenses the IRS says you can deduct. It all goes on a form called Schedule A.
Schedule A, the detailed one.
Exactly. Think of it as your detailed expense report for the IRS. You add up costs within certain categories.
Like what sort of costs?
Well, common ones include medical and dental expenses, but there are thresholds based on your income, so not everything counts immediately.
Ah, okay.
Then you have taxes. You've paid state and local income taxes or property taxes, though there's a cap on those now, too.
Right, the SALT cap.
Interest you paid, usually on a home mortgage, is often a big one. Donations to charities, those count. And sometimes casualty or theft losses, although the rules there got much tighter recently.
So you add up everything that qualifies in those buckets.
Pretty much, you tally up your qualifying expenses for each category.
Okay, seems like it could add up, but also takes effort. So how do you actually decide? Is there a simple rule?
There is. And it's really the core principle here. We call it the golden rule of choice.
Okay, I like the sound of that.
It's simple. You always take whichever is higher your standard deduction amount or are your total calculated itemized deductions.
Always the bigger number.
Always the bigger number. It's about getting the best tax outcome, maximizing your deduction.
Okay, give me an example.
Sure. Let's stick with 2022 numbers. You're single, so your standard deduction is $12,950. You go through all your receipts, add everything up, and your itemized deductions only total $7,000.
Okay.
Well, $12,950, way more than $7,000. So you take the standard deduction, easy choice. You don't even need to file Schedule A.
Makes sense. But what if it's the other way around?
Right. Same single filer, standard is $12,950. But maybe you own a home, paid a lot of mortgage interest, made significant charitable donations, and your itemized total comes out to $17,000.
Ah, now itemizing is higher.
Exactly. $17,000 beats $12,950. So in that case, you absolutely choose to itemize. The effort pays off because you get a bigger deduction, which means less taxable income.
That really clarifies the basic choice. Optimize for the bigger number. But you mentioned surprising nuances before. Are there other things that can affect that standard deduction amount, like bonus points or something?
Bonus points, I like that. Yes, there are. They're called additional standard deductions.
Additional, okay.
These are extra amounts added on top of the regular standard deduction for taxpayers who meet certain conditions. Specifically, if you're age 65 or older. or R if you're legally blind.
Oh, interesting. So one or the other.
One or the other gets you one additional amount, but here's the kicker. If you meet both conditions, say you're 67 and blind, you actually get 2 additional standard deductions added on.
Wow, okay. So it stacks.
It stacks. And just like the basic amounts, these additional amounts also change year to year. For 2022, if you were single and qualified for one condition, either age 65 plus OR blind, you added an extra $1,750.
$1,750 extra.
Yep. So if you were single, 65, and blind, you'd add $1,750 twice. For married folks or qualifying widows, the additional amount per condition was $1,400 in 2022.
$1,400. It might not sound like a huge amount on its own, but I can see how it could definitely tip the scales in that comparison.
Precisely. It can absolutely change whether the standard or itemized deduction is better for you.
Let's try a real-world example. Say we have a married couple, David and Sarah. How would they run the numbers?
Okay, David and Sarah filing jointly in 2022. Their basic standard deduction is $25,900. Let's say they own a home and are pretty active donors.
Okay.
They paid $10,200 in home mortgage interest. Property taxes were $5,600. They gave $7,000 to charity, and they had state and local income taxes of $4,100.
Got it. So we add those up.
Right. $10,200 plus $5,600 plus $7,000 plus $4,100.
26,900. Okay.
Now compare that to their standard deduction, $25,900.
So their itemized total is higher. Just barely, but higher.
Exactly. $26,900 is greater than $25,900. So David and Sarah would choose to itemize. They'd file Schedule A and claim the $26,900 deduction. More tax savings for them.
That makes perfect sense. But now let's bring in those additional deductions. Can you show how turning 65, for example, could flip the script, maybe for someone who usually itemizes?
Absolutely. This is where it gets interesting strategically. Left think about Sarah again, but now filing as single. Suppose for years she itemized because her deductions were consistently just over the standard amount. Let's say her itemized total was $13,200.
Okay, $13,200.
And her standard deduction as a single filer in 2022 was $12,950. Based only on those figures, she'd itemize, right? $13,200 is more than $12,950.
Right, she'd stick with itemizing.
Let's say 2022 was the year Sarah turned 65.
Okay. The additional deduction kicks in.
Exactly. Because she's 65, she gets that extra $1,750 added to her standard deduction using the 2022 single filer additional amount.
So her standard isn't $12,950 anymore.
Correct. Her new total standard deduction becomes $12,950 plus $7,750, which equals $14,700.
14,700. Okay, wait. Now that's higher than her itemized $13,200?
Precisely. All of a sudden, because of that age-based additional amount, her standard deduction, $14,700, is better than her itemized $13,200. So Sarah would switch. She'd take the standard deduction.
And save herself the hassle of Schedule A, plus get a slightly bigger tax break.
You got it. It shows how life changes can directly impact your best tax strategy. It's not always static year to year.
Are there situations where you can't take the standard deduction, even if it looks higher?
Yes, there are a few key restrictions.
Yeah.
One big one is for married couples filing separately. If one spouse decides to itemize their deductions,
Then the other one has to.
the other one must also itemize. Even if their standard deduction would have been higher, they lose the choice.
Wow, okay. That's a major reason for couples to coordinate, even if filing separately.
Definitely. Another group generally barred from the standard deduction is non-resident aliens. The standard deduction is primarily aimed at U.S. citizens and residents.
Got it. Okay, that covers individuals and couples pretty well. What about dependents? Kids who earn some money, maybe other relatives you claim. Are the rules different for them?
They are. Dependents have their own special way of calculating the standard deduction, and there's a really important limit.
Okay, lay it on me.
For a dependent, their standard deduction in 2022 was the greater of 2 amounts. Either a flat $1,150.
$1,150. Minimum.
Right. Or their earned income for the year plus $400.
Earned income plus $400. Okay. So
Yeah.
you compare those two, pick the bigger one?
Yes, but here's the crucial catch, the limitation. That calculated amount, whichever is bigger, cannot exceed the regular standard deduction for a single filer.
The ceiling. So for 2022, it couldn't go above $12,950.
Exactly. That $12,950 for 2022 acts as a cap for dependents. It prevents a dependent, maybe a teenager with a high-paying summer job, from getting a standard deduction larger than what an independent single person would get.
That makes sense. Otherwise, you could have weird situations.
Precisely. And like everything else, these dependent numbers, $1,150, the $400 add-on, the cap, also adjust each year.
Can we run through a quick example with that cap, just to see it work?
Sure. Let's imagine a dependent child, maybe your teenager, who earned $13,800 from a part-time job in 2022.
Okay, 13.8. That's decent earnings for a dependent.
Right. So we did the dependent calculation. We compare $1,150 or their earned income, $13,800 plus $400.
So $13,800 plus $400 is $14,200.
Correct. $14,200 is definitely greater than the $1,150 minimum. So you'd think their deduction is $14,200.
But wait, the cap.
Exactly. But wait, that $14,200 hits the ceiling? Since the standard deduction for a single filer in 2022 was $12,950, the dependent standard deduction gets capped right there.
So even though their calculation was $14,200, their actual standard deduction is limited to $12,950.
You've got it. That cap is key for dependents with significant earnings.
That's a really important detail. Okay, we've covered a lot of ground here, from the basics to the nuances for age, blindness, and dependence. Let's try and wrap this up. What's the main takeaway for everyone listening?
Yeah, what should they walk away with?
I think the biggest thing is that this choice standard or itemized, it's not just about paperwork. It's really a strategic decision.
Totally strategy.
It depends completely on your numbers, your filing status, your age, maybe blindness, what you spent on deductible things, even how much your dependents earn. It's all connected.
Right. Understanding those pieces, the basic amounts, those additional deductions, the dependent rules, the caps, that's what gives you the power to choose wisely.
It's not one size fits all. You have to look at your specific situation each year.
And maybe think about this. How does knowing these rules change how you approach your finances during the year?
Ooh, good question. Like, does it make you track expenses differently?
Exactly. Are you maybe missing out on itemizing because you're not keeping good records? Or bigger picture, could understanding the tax impact of, say, mortgage interest or charitable giving influence major decisions?
Like buying a house or how much you decide to donate.
Yeah, or even planning for retirement. Knowing how these deductions work gives you a clearer view of your whole financial landscape. It's about being informed and proactive, not just reactive when tax time comes.
Making the tax code work for you, not just happening to you.
That's a great way to put it.